When you check gold prices on any financial screen, you're being shown something that isn't real. That number flickering before your eyes, whether it's $2,500, $3,000, or whatever today's quoted rate is, doesn't represent actual physical gold. What you're seeing is simply the value of a digital contract. Here's what's really happening. For half a century now, gold's global value hasn't been set by actual metal changing hands between countries or individual buyers. Instead, it's been controlled through leveraged paper contracts traded in London and New York. This setup, called the paper gold market, gave Western central banks and major bullion dealers the power to manipulate the price of monetary gold without actually possessing the metal itself. Think of it like this. They built a massive gambling house where the betting tickets outnumber the actual gold bars by more than 100 to 1. Why would they do this? Because it served a crucial political goal. It kept the financial system's warning signal turned off. By managing gold's volatility and controlling its price, they made everyone believe the US dollar was the only truly safe place to put your money, but that entire system is now collapsing. The casino is running out of chips, and the people who actually own physical gold are demanding their metal back. We're heading straight toward a price reset that will unadjust gold by a few percentage points. We're talking about multiples. The price could shoot to $10,000, $20,000, or even beyond that in just a matter of weeks. To grasp why this massive repricing can't be avoided, you need to understand how they've been keeping the price down. The main tool has been the futures market in New York combined with London's over-the-counter market. In these markets, gold trades as something called unallocated. Here's what that means. When someone buys unallocated gold, they don't actually own a specific bar sitting in a specific vault with its own serial number. What they own is just a claim against the bank's overall assets. It's basically a credit arrangement. The bank is essentially betting against gold while the investor is betting on the bank staying solvent. For decades, banks operated under fractional reserve rules that let them sell massive quantities of unallocated gold that didn't physically exist. This fake supply flooded the market. When demand for gold increased, banks didn't need to find more miners to dig up more metal. They just created more paper contracts out of thin air. This unlimited fake supply kept prices suppressed. Picture trying to inflate a beach ball while someone strong holds it underwater. No matter how much air you pump in, the ball stays down because there's unlimited downward force. But here's the thing, that strong person is getting exhausted and basic physics is about to take over. The first major crack in this price suppression system came from a boring regulatory change that mainstream media almost completely ignored: Basel III. The Bank for International Settlements, basically. The central bank that oversees all other central banks introduced new banking standards called Basel III to prevent another 2008-style financial crisis. Buried deep in thousands of pages of regulations was a specific rule about something called the net stable funding ratio. Here's what changed. Banks used to classify gold as a risky asset, a Tier 3 holding. This made holding physical gold expensive for banks because they had to keep large cash reserves against it. Meanwhile, unallocated paper gold was cheap and easy to trade. Basel III completely flipped this system upside down. It reclassified physical gold that's actually allocated as a Tier 1 asset, the safest category possible, equal to cash and government bonds. At the same time, it made unallocated paper gold expensive and burdensome to hold. The new rules force banks to hold 85% stable funding against their unallocated gold liabilities. This completely destroyed the economics of the paper manipulation game. It became drastically more expensive for bullion banks to maintain those massive short positions that kept prices artificially low. The regulation basically told banks, either own the real metal or get out of this market entirely. This wasn't some accident. The central bankers who wrote Basel III understood exactly what they were doing. They were getting the banking system ready for gold to become money again. They were sending a clear signal that the era of paper derivatives is ending and the age of physical collateral is beginning. Since this rule started being implemented, we've witnessed a historic split in how global buyers behave. While Western retail investors and hedge funds still trade based on the paper price, The smart money sovereign nations in the East are emptying the physical vaults. The Shanghai Gold Exchange has seen record amounts of gold withdrawn. Central banks in China, Russia, Poland, India, and Singapore are buying gold faster than we've seen since the Bretton Woods system collapsed back in 1971. Here's the critical part. They're not buying futures contracts. They're buying actual 400-ounce gold bars and shipping them back to their home countries. They're physically removing the collateral from the Western banking system. This creates what's called a vault squeeze. The COMEX market works on the assumption that very few people will actually demand physical delivery. Most traders just roll their contracts forward to the next month for price speculation. But as Eastern nations demand actual physical delivery, the inventory of registered gold in COMEX vaults, the gold that is actually available to settle these contracts, is shrinking fast. We reapproaching a mathematical breaking point where the number of claims on gold exceeds the available physical supply so drastically that a default becomes unavoidable. In any normal market, when shortages happen, prices rise to encourage more supply. But because the paper market still controls the price, the market signal is blocked. We have a shortage of physical metal but an oversupply of paper metal. This situation cannot continue. When the bank run starts, when a major player demands delivery of 50 tons of gold and the bullion bank responds with, "We do and have it," here's cash instead, the illusion will be destroyed. The connection between paper price and physical price will break completely. The paper price might collapse to zero as contracts are exposed as worthless, while the physical price will shoot straight up to find its real market value. This true equilibrium price is probably far higher than most people imagine because gold acts as the ultimate measure of the money supply. If you compare the US dollar M2 money supply to America's official gold reserves, roughly 260 million ounces, the numbers are frightening. In 1934 and again in 1980, gold prices rose until the value of the Treasury's gold holdings equaled approximately 20% to 40% of the monetary base. This backing restored trust in the dollar. Today, with M2 money supply sitting around $21 trillion, for gold to back just 20% of the U.S. money supply, the price would need to reach roughly $16,000 per ounce. To back 40%, the 1980 peak ratio gold would need to hit $32,000 per ounce. Right now, at $2,500, gold is backing less than 3% of the money supply. This is completely abnormal historically. It means either the dollar is massively overvalued or gold is massively undervalued. Given the exponential explosion of U.S. debt and the government's refusal to reduce spending, it's the dollar that must adjust downward. And the way that adjustment happens is through a sudden, violent revaluation of gold. This isn't some new idea. It's happened before in American history, deliberately orchestrated by the government itself to solve a debt crisis that looked remarkably similar to what we're facing today. The roadmap for the coming $10,000 revaluation was written back in 1933, and those in power are pulling it out right now. The playbook for what's coming was created during the depths of the Great Depression, the last time in history when the United States faced a debt crisis of this scale. In 1933, the U.S. government was trapped. It had promised to exchange paper dollars for gold at a fixed rate of $20.67 per ounce. But it had printed way too many paper dollars and didn't have enough gold to honor those promises. The honest approach would have been to stop printing money or default on the debt. Instead, President Franklin D. Roosevelt chose the predatory route. He simply changed the price. After forcing American citizens to surrender their gold to the government through executive order, 6,102 making them sell their wealth at the old price, Roosevelt pushed through the Gold Reserve Act of 1934. With just his signature, he revalued gold from $20.67 to $35 per ounce. This wasn't some random adjustment. It was a deliberate devaluation of the dollar by nearly 70%. Instantly, the paper profits on the government's gold stash exploded. The Treasury suddenly had billions of dollars in new book value that it used to fund a stabilization program, essentially printing money to rescue the banking system without technically creating new debt. It was the ultimate accounting trick. By admitting the currency was worth less, the government's assets became worth more. Today, the Federal Reserve and Treasury are quietly setting the stage for a repeat of 1934, but this time on a worldwide scale. The U.S. government officially holds roughly 261 million ounces of gold, mainly in Fort Knox and West Point, at today's suppressed price of roughly $2,500 per ounce. This stockpile is worth about $650 billion, basically a rounding error compared to the dollar. 36 trillion national debt. It does nothing to improve the government's solvency. However, the mathematics change dramatically if the price resets. At $10,000 per ounce, the U.S. gold reserve becomes worth $2.6 trillion. At $50,000 per ounce, it becomes worth $13 trillion. Suddenly, the gold on the government S-books becomes a massive asset that can be used to erase sovereign debt or save a bankrupt Federal Reserve. This is the nuclear option of monetary policy. It lets the government wipe out the real value of what it owes while keeping the stated face value of its bonds unchanged. It's a soft default dressed up as a market repricing. This logic explains the mysterious and aggressive actions of global central banks over the past 2 years. While financial media ridicules gold as a worthless pet rock, central banks in the global East are engaged in the most significant physical bullion accumulation since Bretton Woods collapsed. The People's Bank of China has officially added gold to its reserves for 18 straight months, but analysts believe the official figures are just a fraction of reality. By tracking net exports from Switzerland and the UK to Hong Kong, experts estimate China has imported thousands of tons of gold without reporting it, likely holding it in other state entities like the State Administration of Foreign Exchange or even the military. They not reporting these holdings to the IMF because they do and want to drive up the price yet. They're stacking poker chips before the rules of the game change. Why are they doing this? Because they know the current fiat system built on the petrodollar and U.S. Treasury collateral is reaching its mathematical breaking point. They're preparing by accumulating a neutral reserve asset that cannot be sanctioned. When the U.S. froze Russia's dollar reserves in 2022, it sent shockwaves through the non-Western world. Every nation realized that if their reserves were held in treasuries, they were only secure as long as Washington approved of their foreign policy. Gold is the only financial asset that isn't someone else's liability. It has no counterparty risk. It can't be frozen through a swift message. It can't be diluted by a central bank's printing press. By converting their trade surplus into physical gold, nations like China, Russia, India, and Saudi Arabia are effectively leaving the dollar system while remaining part of the global trade system. This accumulation is creating a hidden gold price. We're starting to see a fundamental split in the market. In the West London and New York, the price is determined by paper futures and interest rate expectations. In the East Shanghai and Dubai, the price is determined by physical supply and demand. For months at a time, gold has traded at a significant premium in Shanghai compared to London, sometimes $50, $100, or even higher per ounce. This price gap shouldn't exist in an efficient market. Traders should simply buy in London and sell in Shanghai until prices equalize. The fact that this premium continues suggests the physical metal is trapped. It's not flowing freely. The good delivery bars in London are being drained, melted down, recast into kilogram bars, the preferred standard in Asia, and vanishing into Eastern vaults, never to return. The West is selling its wealth to buy the East's consumer products, and the East is gladly accepting the exchange. The trigger for the inevitable revaluation will likely be a breakdown in the exchange for physical mechanism. The COMEX market depends on the ability of large traders to swap their futures contracts for physical London bars if they actually want the metal. When London's inventory drops to critically low levels, the bullion banks will have to shut the door. They'll declare force majeure or only offer cash settlements. This is when the price disconnects. We'll see a paper price that might crash or freeze and a street price for physical coins and bars that rockets vertically. Imagine checking your investment account and seeing gold at $2,500 per ounce. Moreover, the revaluation to $10,000 isn't just wild speculation. It's actually a requirement for the proposed BRICS currency being discussed by these nations. Russia and China have openly talked about creating a new trade settlement currency backed by a basket of commodities, with gold as the primary foundation. For such a system to function, to have enough liquidity to settle trillions of dollars in global trade, the gold backing must be valued high enough. You simply cannot back $20 trillion of global trade with gold priced at $2,000 per ounce. The physical supply is too limited, you'd run out of gold within a week. But if you reprice gold to $10,000 or $20,000, suddenly the physical stock becomes valuable enough to support the liquidity needs of global energy and manufacturing markets. The price of gold is simply an exchange rate between a limited asset and an unlimited currency. As the BRICS nations move to monetize gold, they'll have every reason to allow the price to rise. A higher gold price increases the buying power of their reserves and devalues Western debt. It's a form of asymmetric financial warfare where the so-called barbarous relic becomes the ultimate strategic weapon. The timeline for this is speeding up because of fiscal dominance. As the U.S. deficit spirals completely out of control, the Federal Reserve will be forced to print more dollars to keep interest rates down. This printing will push more capital into hard assets. The feedback loop is activating. The more they print, the more the East buys gold. The more the East buys gold, the fewer treasuries they purchase. The fewer treasuries they buy, the more the Fed must print. We're watching the final chapter of the 50-year experiment with unbacked money. The market is detecting the insolvency. Central banks are voting with their vaults. The paper dam is cracking. And when it finally breaks, the revaluation won't unfold over a decade of gradual increases. It will likely happen over a single weekend when markets are closed. It absolutely is not. In the coming crisis, how you own gold will matter just as much as owning it at all. This brings us to the paper gold trap. Millions of Americans think they re-protected because they own shares of an ETF like GLD or have a gold account with some digital app. They're walking into a burning building carrying gasoline. To understand why, you need to examine the legal structure of these products. When you purchase shares in a major gold ETF, you don't own gold. You own shares in a trust that has a claim on gold. This difference seems meaningless until the market breaks. The ETF system relies on a group of middlemen called authorized participants, usually the same too-big-to-fail banks that are shorting the market. These banks are responsible for moving physical gold in and out of the trust to keep the share price aligned with the spot price. But if you actually read the prospectus of the largest gold funds, the legal fine print nobody bothers, reading you'll find a force majeure clause. It states that if the custodian cannot deliver gold due to natural disaster, war, or critically disruption in financial markets, they're not required to give you metal. They can settle your position in cash. In a revaluation scenario, this is the kill switch. Imagine gold gaps from $2,500 to $5,000 overnight because COMEX has defaulted. The ETF manager can legally close your position, hand you $2,500 in devaluing cash and say, "Sorry, market disruption. You missed the entire move." You're left holding the exact paper currency you were trying to protect yourself against, while physical metal becomes impossible to obtain at any price. This is why serious gold investors live by the rule: if you can't hold it, you don't own it. This raises the question of confiscation. The ghost of 1933 haunts every gold conversation. People worry the government will send agents door-to-door seizing coins. In the 21st century, the government doesn't need to break down your door. They have more sophisticated tools. They don't want your gold. They want the value of your gold. The modern version of Executive Order 6102 will probably be a windfall profits tax. If gold reaches $10,000, the government can simply declare that any gain above $3,000 is taxed at 80% or 90%. They'll frame it as fairness. They'll say, while the country is struggling, these hoarders are getting rich. This effectively confiscates the wealth without the negative publicity of physical seizure. To defend against this, you must think about jurisdictional diversification. Storing some of your gold outside the U.S. banking system in a private, non-bank vault in a jurisdiction with strong property rights like Singapore, Switzerland, or the Cayman Islands is the only way to protect against the domestic wealth tax. It creates a legal barrier. It transforms your wealth from a domestic target into international capital. However, for those looking to not just preserve wealth but generate life-changing profits during this transition, there's an asset even more explosive than gold: silver. Silver is called the poor man's gold, but it's also the industrialist's worst nightmare. Unlike gold, which sits in vaults, roughly 60% of all mined silver gets consumed by industry. It's in your smartphone, your solar panels, your electric vehicles, and your military weapons. It's a strategic metal that's disappearing. We're currently in a structural deficit. The world uses more silver each year than gets mined. Above-ground stockpiles are draining. Yet the gold-to-silver ratio, the number of silver ounces needed to buy 1 ounce of gold, is hovering near historic highs, often above 80 to 1, geologically. The ratio in the Earth's crust is about 17 to 1, historically. The monetary ratio has been 15 to 1. During a monetary reset, this ratio tends to snap back. If gold hits $10,000 and the ratio returns to its historical average of 15 to 1, silver would need to rise to roughly $660 per ounce. From a current price of $30, that's a 20 times return. Silver acts as a leverage play on the collapse of the fiat system. It's volatile, it's chaotic. But it has the highest potential upside of any asset during a currency crisis. The endgame we're approaching represents a shift from return on capital to return of capital. For 40 years, investors chased yield. They bought bonds, tech stocks, and rental properties to get 5% or 10% returns. During a currency collapse, the objective changes. You're no longer trying to get wealthy. You're trying to avoid becoming poor. The revaluation of gold to $10,000 isn't a lottery ticket. It's a lifeboat. It represents the transfer of purchasing power from those who trust government paper to those who trust physical metal. The window to exchange your paper dollars for physical metal is closing fast. Premiums on physical coins are already climbing. Delivery times are already extending. Central banks are already positioned. Billionaires are already positioned. They waiting for that Sunday night announcement, the moment when the president or Treasury Secretary steps up to the podium and announces a modernization of the monetary system. When that happens, gold's price won't slowly drift higher. It will explode higher, and if you're waiting for a dip to buy, you'll be left behind permanently. The $10,000 revaluation isn't a question of if. It's a question of when, and when is coming fast.